Ruth, 45%. That is how much of my index fund is now in 7 companies. 7 out of 500. I opened my brokerage app last night and just stared at it. The Magnificent Seven, these AI companies, they are a third of the entire S&P 500. And the top 10 stocks are 40%. I bought this fund because everyone said diversify. 500 companies. Spread the risk, but 45% of my money is riding on one theme.
And you are not wrong to feel uneasy about that. Because that number, 40% of the index in 10 stocks, is the highest concentration we have seen since the year 2000.
The dot-com bubble. That is exactly what I keep thinking about.
And here is why that comparison matters. The last time concentration was this high, the Nasdaq lost 78% over 2.5 years. 78%. If you had $100,000 in the Nasdaq in March of 2000, you had $22,000 by October of 2002. That is the cost of ignoring concentration risk.
78%. $100,000 becomes $22,000. That is terrifying.
It is. But here is what I want you to understand. Today is not 2000. The data tells a much more interesting and nuanced story than it is the same thing. And by the end of this conversation, you are going to know exactly what is different, what is the same, and what to do about it.
Before we get into the data, I want to know something. Drop a comment. What percentage of your portfolio is in the Magnificent Seven? Do you even know? Because I did not until last night. And if this kind of calm, data-driven analysis helps you think clearly about your money, hit subscribe. We do this every week.
All right, let us get into it. I want to walk you through what I call the concentration trap. It has 3 components, and each one reveals a different layer of what is actually happening in the market right now.
The concentration trap. Okay, break it down for me.
The first component is what I call the illusion of diversification. You own an S&P 500 index fund, 500 companies. That sounds diversified. But cap weighting means the biggest companies get the biggest share of your money. And right now, 7 companies control 33.7% of the entire index. The top 10 are 40%.
Okay, so wait. Let me make sure I understand. I own 500 stocks on paper, but a third of my actual dollars are in 7 companies. All in tech. All betting on a pie.
That is exactly right. Same sector. Same thesis. Same risk. And here is the part that surprises most people. The top 10 stocks are 40% of the S&P 500 today versus 27% in 2000. That is nearly 50% higher concentration than the dot-com peak.
Hold on. Concentration is worse now than during the dot-com bubble? 40% versus 27?
That is right. More concentrated today than at the peak of the biggest bubble in modern history. But, and this is critical, concentration alone does not tell you whether something is a bubble. You also need to look at what you are paying for those concentrated positions.
Okay, so give me the valuation comparison. Because that is what everyone wants to know. Are we paying dot-com prices?
We are not. And the gap is enormous. The dot-com Nasdaq traded at 60 times forward earnings. The S&P 500 today trades at 23 times. Dot-com companies were burning cash with zero revenue and no path to profitability. The Magnificent Seven generated hundreds of billions in actual profit last year.
60 times versus 23 times. That is not even close.
It is not. And let me give you the most specific comparison. Nvidia, the poster child of the AI boom, trades at 22 times forward earnings. Cisco was at 100 times when the dot-com bubble burst. The Shiller-Cape ratio is at 38 today. The dot-com peak was 44.19. So on almost every valuation metric, today is expensive, but it is not dot-com expensive.
22 times versus 100 times. Okay, so the prices are way more reasonable. But you said concentration is worse. So what does that actually mean for my money?
It means the risk is different. In 2000, you were paying insane prices for companies with no earnings. Today, you are paying reasonable prices for incredibly profitable companies. But those profitable companies are a bigger share of your portfolio than the dot-com stocks ever were. So the question is not, is this a bubble? The question is, what happens to my portfolio if these 7 companies stumble, even temporarily?
That is a much better question. It is not will AI crash. It is what happens to my specific portfolio if AI has a bad year.
Exactly. And that brings us to the second component of the concentration trap. I call it the monetization test.
The monetization test. What is that?
Something fundamental changed in 2026, and it is the single most important thing happening in the market right now. These 7 companies are spending an absolutely staggering amount of money on AI. Combined, they are spending $725 billion on AI infrastructure this year. That is up 77% from last year. And next year, it is projected to exceed $1 trillion.
$725 billion in 1 year. And next year, over $1 trillion. That is an insane amount of money.
It is. And here is what changed. For the first 2 years of the AI boom, 2023 and 2024, the market rewarded the spending itself. You announced a big AI budget, your stock went up. But in 2026, that stopped working.
What do you mean it stopped working?
Let me give you 2 examples from the same quarter. Alphabet reported that Google Cloud revenue grew 63% year over year. The stock surged. Same week, Meta raised its AI capital expenditure guidance to between $125 billion and $145 billion. The stock fell 8%. Same sector. Same AI bet. Opposite market reactions.
Wait. One company shows AI revenue growth and gets rewarded. The other announces massive AI spending without showing the revenue and gets punished. Same week?
Same week. And Forbes put it plainly in April. Investors are no longer rewarding AI spending. They are rewarding AI payoffs. That is the monetization test. The market is now asking every company the same question. You are spending billions on AI. Show me the revenue.
Show me the revenue. That is such a simple question. So Google passed because cloud revenue actually grew. And Meta failed because they announced more spending without enough results to show for it.
That is right. And here is why this matters for your index fund. Your S&P 500 holds both the companies passing the monetization test and the companies failing it. And they are weighted by market cap, not by whether they are actually making money from AI. So your diversified fund is giving the same proportional weight to the winners and the companies that have not proven their AI spending is paying off.
That is uncomfortable. My index fund does not know the difference between a company earning from AI and a company just spending on AI.
Exactly. And that brings us to the third component. What I call the equal weight escape.
Okay, this sounds like the part where you tell me what I can actually do about it.
If concentration worries you, there is an alternative most people do not know about. The equal weight S&P 500. Same 500 companies as the regular S&P 500. But instead of weighting by market cap, where the biggest companies dominate, it weights every company equally. Each one gets 0.2%. So instead of 7 companies controlling a third of your portfolio, every company gets the same share.
Same 500 companies, but each one gets an equal slice. So the Magnificent Seven would only be about 1.4% of the fund instead of 33%.
That is right. And here is the interesting part. In 2026, the equal weight S&P 500 is outpacing the cap weight version by about 5% year to date. And historically, after periods of extreme cap weight outperformance, and the gap between cap weight and equal weight was the widest since 1971, During 2023 through 2025, equal weight tends to catch up.
So the equal weight version is actually winning right now, after years of the big stocks dominating.
It is. Now I want to be clear. This is not a prediction that equal weight will always win. When a few big companies are on a tier, cap weight crushes equal weight. That is exactly what happened from 2023 to 2025. But equal weight is a hedge against concentration risk. It is not about abandoning the index. It is about understanding what you own.
And you mentioned something I want to come back to. 83% of professional fund managers are underweight the Magnificent Seven. What does that mean exactly?
It means 83% of professional fund managers are holding less of the Magnificent Seven than the index weight. They are not betting against these companies. They are just saying, 33% in 7 stocks is too concentrated for my risk tolerance. So they are spreading their bets more evenly. That is 83% of the people who do this for a living.
83%. So the vast majority of professionals are looking at the same data we just talked about and saying, that is too much concentration for me.
That is right. They are not saying AI is a bubble. They are not saying sell everything. They are saying the concentration does not match their risk tolerance. That is a very different statement than AI is going to crash.
Okay, so we have the 3 components of the concentration trap. The illusion of diversification. Your 500 stock index fund is really a 33% bet on 7 companies. The monetization test. The market is now separating AI spenders from AI earners. And the equal weight escape. Same companies without the concentration. Now what do I actually do with all of this?
Let me give you the concentration trap checklist. 3 things you can do this week.
Give me the checklist.
Step 1. Know what you own. Log into your brokerage account and look at your actual holdings. If you own an S&P 500 index fund, look at the top 10 holdings and their combined weight. Most people have never done this. They bought the fund because someone said diversify and never looked inside. Understanding that 40% of your index is 10 stocks is not a reason to panic. It is a reason to be informed.
Step 1 is literally just look inside your index fund. I bet most people listening have never done that.
Step 2. Decide your concentration comfort level. There is no right answer here. Some people are perfectly comfortable with 40% in 10 stocks because they believe in those companies long term. Other people want more balance. Neither is wrong. But you should make that decision consciously, not by accident. If you want less concentration, consider adding an equal weight fund alongside your cap weight fund. Not replacing it. Adding to it.
So it is not sell your index fund. It is maybe hold both, cap weight and equal weight together.
Exactly. Step 3. Apply the monetization test to the headlines. Every time you see a headline about AI spending, ask one question. Is this company turning AI spending into AI revenue? If the answer is yes, like Alphabet's 63% cloud growth, that is a company passing the test. If the answer is, we are spending $145 billion, and we will figure out the revenue later, that is a company that has not passed yet. You do not need to trade on this, but understanding the difference will help you stay calm when the headlines get loud.
I love that. It is not about trading. It is about understanding. So when I see a headline that says AI bubble is bursting, I can ask, which companies? The ones making money or the ones just spending money?
That is exactly the right question. And that is what separates a calm investor from a panicked one. The panicked investor sees AI bubble and sells everything. The calm investor asks, what does concentration mean for my specific portfolio? And does it match my risk tolerance?
Okay, let me bring it all together with the takeaways. Number 1, AI. Stocks now make up 45% of the S&P 500. The Magnificent Seven control 33.7%. The top 10 stocks are 40%. That is nearly 50% higher concentration than the dot-com peak. Your index fund is not as diversified as you think. Number 2. This is not the dot-com bubble. Valuations are 23 times versus 60 times. Nvidia is at 22 times, not Cisco's 100 times. These companies are massively profitable, but concentration is worse than 2000. The prices are better. The weighting is not. Number 3. The monetization test is now separating winners from losers. $725 billion in AI spending this year. Google Cloud grew 63% and got rewarded. Meta raised Capex to $145 billion and got punished. The market is no longer rewarding spending. It is rewarding results. Number 4. The equal weight S&P 500 gives you the same 500 companies without the concentration. It is outpacing cap weight by 5% in 2026, and 83% of professional fund managers are underweight, the Magnificent Seven. The pros are managing concentration. You can too. And number 5. Use the concentration trap checklist. Know what you own. Decide your concentration comfort level. Apply the monetization test to the headlines. This is not about predicting whether AI is a bubble. It is about understanding what you own and making sure it matches your risk tolerance.
The concentration trap is not a sell signal. It is an awareness signal. The companies driving AI are real. The profits are real, but the concentration is also real. And the calm investor does not ignore concentration or panic about it. The calm investor understands concentration, measures it, and decides what to do about it. Build wealth with patience, not panic.
Follow calm investors wherever you are listening.